Earlier this month, Steve Blitz said he didn't expect Washington to come to an agreement on the debt ceiling until the very last minute. It now looks like that prediction is coming true. Steve Blitz is a director and senior economist at ITG Investment Research. He's joining us now to talk about what ifs of default as well as downgrade. Welcome back to the show, Steve. Good to have you on Fast Forward as always. Adam did an interesting look there because I think many people who are watching the Treasury market are surprised to see just how calm the market is. And if you do look at the CDS market, there is some activity there on U.S. Treasuries. I was taking a look back to September of 2009. It looked like CDS on U.S. Treasuries were trading about 60 basis points. We're now back at that 56 basis point level, something we haven't seen in quite a while at least. What are your thoughts on this?
Well, I think, first of all, the CDS market, as far as the treasuries are concerned, is just a gambling market. And you might as well look to see whether or not there's a market at a casino in Las Vegas. It's not a contract like a treasury note or a treasury bond contract that trades on an exchange where there's transparency in prices. You don't know how much of the price is reflecting the creditworthiness of who's on each side of the trade. So, to be honest, I don't really put a lot of stock into it. It's much more important to look at where Treasury yields are because that's the big liquid market, and that's where the problems would arise if there's going to be a problem such as an actual default. Let's
say a rating agency downgrades U.S. debt. Do you think there's going to be a big reaction from the Treasury market or Treasury traders at this point? Thus far, the conversations have not sparked a sell-off.
No, it hasn't, and because most people think this is just a lot. Once again, the agencies are involved in a bit of political posturing themselves, considering their own track record. Typically, in the corporate bond market, by the time that their agencies come and change the ratings, the market's already traded the actual security to that new rating level. They usually lag as opposed to lead market pricing. Where it does have an impact is legally whether or not an institution can hold that security at AA versus AAA, say a money market fund, whether or not it changes the haircut in terms of margins, the amount of margin that you're putting up in terms of in treasuries, being that now it's a AA versus a AAA. This is where a shift in the rating really matters.
And that was something, I don't know if you had a chance to watch Zara Burton. She was on earlier talking about one analyst report trying to quantify the ripple effect of a downgrade on U.S. debt. Have you taken a look at that, and is that something your clients at this point are very concerned with?
Well, they're not concerned because they don't think it's going to happen. But yes, it is a very big concern. And I would like to think that if you go back to 2007, when Bernanke and Bill Poole, with all the authority they could muster, were telling everybody that this thing with subprime was just a little corner of a market and it's not going to cascade and impact the economy as a whole, and we saw what happened. The treasuries would just be that much worse in multiples.
And what's the best outcome in terms of a plan that's being offered? Lots of rival plans being thrown out there, lots of temporary plans being thrown out there. What do you think is the best outcome at this stage for the U.S. economy?
The best outcome, and looking at the markets, if you look at the 10-year tips, everyone likes to focus on the inflation break even. But let's look at the actual real yield. It's trading at about 56 basis points. Now, that should trade around 2%. So what the market is telling you is that over the next 10 years, people think that the U.S. economy is barely going to grow in real terms, which is a terrible outcome in terms of employment and growing our way out of the budget. The budget issue, okay, is not politics. The budget issue is a weak economy, and the market is telling you it's going to be weak. So the best outcome would be to raise the debt ceiling and get involved in a better tax policy that lowers rates, broadens the base, and favors investment over consumption and exports over imports. And that begins to shift the balance within the U.S. economy so that we will get real growth, and that will cover an awful lot of the shortfalls people are talking about.
Is there a plan that is being proposed right now, whether it may be a plan that's no longer even being considered? Let's talk about the Gang of Six plan, but is there one that out there that you think is the best given the scenario you just painted?
I haven't heard one because, well, first of all, they're changing all the time.
Right.
But I haven't really heard one because none of them, all of them, are focused on trying to address the budget deficit first. And what they should really be doing is focused on addressing the growth problem in this country and getting a fairer, cleaner tax system that gets you there, because at the end of the day, that is what's going to grow the revenues that will take care of the budget. Let's
talk quickly now just about the economy as it stands at the moment. You're looking for second quarter GDP to come in a little bit lower than consensus, 1.6%. You also take a look at some very interesting indicators. You look at hotels, you look at railways, you also look at containers. Tell me what you see in terms of macro indicators out there for the U.S. going forward.
Well, I look at the U.S. economy in sort of two sectors. There's the real goods sector, manufacturing industry, which includes Apple and high tech as well. And there we see the economy in the second quarter, it ratcheted down to a lower rate of growth, and it stayed there. It is not deteriorating any further. Our indicators on labor demand, internet job ads, things like that, tell us that that's also not, it's not getting better, but it's not deteriorating any further. And there are even signs, such as on rail shipments of industrial products, as well as on hotel rates late in the year, that tell us that there's a little bit of life out there in terms of the real goods sector. The catch, or the problem right now, is whether or not the consumer, which is clearly spending less and deteriorating, well, that pushes the economy further south. And my guess is, at the moment, this is barring whatever comes out of the debt ceiling and all of that. At the moment, I would say that the consumer is also ratcheting down to a lower level of spending. That gives us 2.5% real growth, but there's nothing that says that the economy is cratering or anything like even what we saw third quarter last year.
And that's the U.S. consumer you're talking about.
Yes.
You know, as we are now in the thick of earnings season, we're seeing a lot of multinational companies that say that international sales can make up for whatever they're not getting here in the U.S. What do you think about that?
I think that's great, and I think that's the direction. I mean, the U.S. Economy has been way too reliant on the U.S. consumer for growth. And part and parcel of getting to what we're talking about before, a better balanced economy, means closing that export-import gap. So to the extent that U.S. firms are looking more and more to find their revenue growth overseas, that's positive. And I would say, broadly speaking, any firm that's doing that is a good firm to invest in long term.
All right, Steve, we got to end it there. Always appreciate the insight. That was Steve Blitz, senior economist at ITG Investment Research.